look at silver at $30, still 60% of its all-time high in 2011 and in 1980 at $50. Ask yourself, why would a half a dozen commercial banks have the largest short position in silver of any commodity traded on COMEX? It's a concentrated short position. There's nothing even close to it. And I think it has to do with silver's role in the military industrial complex, in its need for the building of high-tech weaponry, namely the missiles and aerospace, that the Silver Institute conveniently has omitted from their supply-demand fundamentals. Yet I have a friend at the Department of Defense who tells me, indeed, he helped design the Patriot missile and said there's between 13 and 14 kilograms in the tip of every Tomahawk cruise missile. Excuse me, Tomahawk, not Patriot. He helped design it. Told me this. 3 times he's told me this in person. Google it. You'll see something similar to that. But it's omitted in the supply-demand fundamentals numbers for the Silver Institute. And if you believe that the military-industrial complex is as powerful or more so than Washington, then understand this is why they hold it down. And they hold down the price of gold because it's really the opposite of the bond market. It is the opposite of our system. These distortions, these manipulations will all end and end badly. And I think the countries that are now uniting against the West understand you don't have to fire missiles to beat the West. You can just massively stand for delivery and drain the exchanges of all their metals and blow up the bullion banks like JP Morgan, like Bank of America, like Deutsche Bank, like Standard Chartered, like HSBC. And isn't it ironic that HSBC, Deutsche Bank, Standard Chartered, and JP Morgan all showed up for 4 weeks in a row, starting the second week in March? You go to the Shanghai Gold Exchange website, you'll see second week, third week, fourth week, and first week in April. And you cannot export gold out of China, but you can silver. And take a look at the vaults of the Shanghai Metals Exchange since the second week in March when they showed up. It's falling straight down to its lowest level in a very long time. And I believe it's exactly that they're trapped, that they've issued so much paper against these contracts, and these countries are standing for delivery. They're trapped. And if they can't deliver, a bank like JP Morgan, what would happen if they defaulted on billions of dollars worth of silver? Gold and silver aren't going higher. It's the dollar that's losing value globally. And as the dollar loses confidence and loses value, the one measurement of all of this, the barometer of all of it, is gold and silver, which I think will become higher in value than people think possible in the face of a falling dollar, in the face of all the Western currencies, which are losing confidence in a world where things can be completely and totally weaponized against you if you're not on the same, ideological train of thought the way the West is. We haven't seen anything yet. And but again, I want to make it very clear, Danny, that I don't tell people to buy gold and silver to become wealthy. I tell them to buy it because it is wealth. That has outlived 2 world wars, German hyperinflation, the Great Depression, every pandemic, and through all of this, in a world that is very digital and very, financial instrument driven, that the most influential, well-funded, well-informed traders in the world are buying it at a level no one's ever seen.
Andy Schectman's analysis of the current economic and precious metals landscape offers a compelling case for why gold and silver should be considered essential components of any investment strategy. At $30 per ounce, silver is still only 60% of its all-time high of $50, which it reached in both 1980 and 2011. This discrepancy raises critical questions about why a handful of commercial banks maintain the largest short position in silver of any commodity traded on COMEX. Schectman suggests that this concentrated short position is driven by silver's critical role in the military-industrial complex, particularly in the manufacture of high-tech weaponry, such as missiles and aerospace components. For instance, silver is a vital component in the Tomahawk cruise missile, with between 13 and 14 kilograms used in each missile. This significant use of silver in defense technology, which the Silver Institute omits from its supply-demand fundamentals, underscores its strategic importance. The suppression of silver prices through massive short positions by banks like JP Morgan, Bank of America, Deutsche Bank, and HSBC reflects broader market manipulations intended to maintain the current financial system. These banks have substantial vested interests in keeping silver prices low, as high prices could significantly increase the cost of manufacturing advanced weaponry. Additionally, a rising silver price signals broader economic instability and lack of confidence in fiat currencies, which these banks are heavily invested in. Schectman notes that the recent behavior of these banks at the Shanghai Gold Exchange is telling. Since the second week of March, these major banks have been active in the Shanghai market, where they can export silver, but not gold. The vaults of the Shanghai Metals Exchange have seen a steep decline in silver inventories, indicating that these banks are attempting to cover their short positions by delivering physical silver in a market where it is becoming increasingly scarce. The rising prices of gold and silver are not merely a function of increasing demand, but also reflect the declining value of the dollar. As global confidence in the dollar wanes, these precious metals serve as a barometer for economic health. A falling dollar and rising gold and silver prices indicate a loss of confidence in Western currencies, highlighting the need for tangible assets that retain value. Schectman emphasizes that investing in gold and silver is not about getting rich quickly, but about preserving wealth. These metals have outlasted world wars, hyperinflation, the Great Depression, and various financial crises. In a world dominated by digital financial instruments, the most influential and well-informed investors are buying gold and silver at unprecedented levels, indicating a strategic move to safeguard wealth against economic instability. The strategic accumulation of gold and silver by central banks and savvy investors signals their anticipation of significant shifts in the financial system. As market manipulations unwind and the true value of these metals becomes apparent, those holding physical gold and silver will be well positioned to benefit from the resulting price adjustments.
I think that gold and silver will go higher than anyone thinks possible once all of this becomes more realized in the mainstream, let alone just the people like me who are out there screaming that this is all not true. And it isn't true. If you dig a little bit and look under the covers, you can see that what is being said really isn't true. The biggest money in the world, I think, has come to a conclusion that assets, commodities, are more valuable than currency right now. And I really do believe the gold and silver markets are playing by a different set of rules. And that's going to catch a lot of people off guard when this starts to fully accentuate itself in an environment where there is way more paper contracts issued than the bars backing it, which is distorting the real value, the price discovery, and the real supply-demand imbalance. And when that breaks, which I think we've never been closer to it, because of the drive to remove counterparty risk, because, I mean, I don't want to ramble too much. I have a bad habit of doing that. But look at India. Not only did India buy more gold, 1.5 times what they bought all of last year, they brought back 100 metric tons from the Bank of England. They don't want the counterparty risk. Saudi Arabia and Egypt and half a dozen African countries just repatriated all of their gold from the New York Fed, the Bundesbank from Germany, the Dutch National Bank, the Czech National Bank, the Bank of Turkey, Hungary, Poland, Austria. They all brought their gold back over the last few years from the Bank of England and the New York Fed, and they're all buying it in a very private manner. Remove counterparty liability, counterparty risk. So when this goes, it will go in a manner that catches people completely and totally off guard. And so, yeah, I think don't listen to what they're saying. Look at what they're doing, I guess is the easiest way to say it. Precious metals are two of the only asset classes that haven't been distorted by suppression of interest rates and all the money that's poured into it because of the huge suppression on the LBMA and COMEX. You know, give you an example of what I mean by the huge suppression and why I said I think that the banks are in trouble in the silver market. So the LBMA says that they trade 292 million ounces of silver per day, 20 million ounces of gold per day. Yet they have also recently admitted in a survey that was done with the bullion banks, those numbers are understated by a factor of 10 times. Because if I sell you 20 contracts and I buy 10, that's a net 10. Instead of the 30 contracts that I traded, it's only the net. And so they're saying that it's 10 times the amount of contracts traded. So that would mean that they are trading 2,920,000,000 ounces of silver per day in London, which is 3.5 times the global mining supply, 3.5 times per day. That means that they're trading not 20 million ounces, but 200 million ounces of gold per day. the majority of all of these contracts are just promises to deliver in a world where none of these companies stand for delivery. None of these entities stand for delivery until they do, and they have been. And that's why you see all of the exchanges being bled dry. The distortions created by a marketplace that rehypothecates and massively rehypothecates all of the contracts being sold. The COMEX is at 1,700% rehypothecation in silver, less than that in gold. But the point of it is that you have a situation where these markets, these Western markets, have controlled the prices of commodities, and in particular gold and silver, because they represent the antithesis to the Western system, where if gold and silver were flying, it would signal problems inherently within the system. So they would suppress the price of gold and silver by issuing copious amounts of paper contracts that mitigate the rise. You can hold the price down by continually shorting and shorting and shorting and shorting all of these contracts because you're a bullion bank with unlimited money.
Continuing his analysis, Schectman delves deeper into the structural issues plaguing the precious metals market. The suppression of gold and silver prices through paper contracts is a temporary phenomenon that cannot last indefinitely. The disconnect between the paper markets and the physical demand for these metals is growing, and when this gap closes, it will do so rapidly and dramatically. India's recent behavior is illustrative of this trend. India has purchased more gold in the first few months of the current year than in all of last year, and has also repatriated 100 metric tons of gold from the Bank of England. This move is part of a broader trend among countries to reduce counterparty risk by bringing their gold reserves home. Nations like Saudi Arabia, Egypt, and several African countries have similarly repatriated their gold from major financial centers like New York and London. This trend reflects a growing distrust in the traditional financial system and a desire to hold tangible assets directly. The London Bullion Market Association, LBMA, admits to trading 292 million ounces of silver and 20 million ounces of gold per day. However, these figures are understated by a factor of 10 due to the practice of netting trades. This means the actual trading volume is much higher, with silver trading around 2.92 billion ounces per day, which is 3.5 times the annual global mining supply. Similarly, gold trading volumes are vastly higher than reported, reflecting a market dominated by paper contracts rather than physical metal. These enormous trading volumes highlight the fragility of the current system. The issuance of paper contracts far exceeds the available physical metal, creating a situation where a significant increase in delivery demands could trigger a massive short squeeze. This scenario would expose the true scarcity of these metals and lead to a rapid increase in their prices. As countries and large investors continue to accumulate physical gold and silver, the pressure on the paper markets will increase. The eventual reconciliation between paper and physical prices will likely result in a substantial revaluation of these metals. Investors who recognize this trend and position themselves accordingly will benefit from the resulting price appreciation. Schectman also addresses the broader implications of these market dynamics. A rising gold price is not just a sign of a failing currency, it also indicates a loss of confidence in the current financial system. As inflation erodes the value of fiat currencies, tangible assets like gold and silver become more attractive. This shift in investor behavior is evident in the increasing premiums on physical metals and the strategic moves by central banks. For individual investors, the key takeaway is to recognize the importance of holding assets that preserve value. Gold and silver have stood the test of time as reliable stores of wealth. By diversifying portfolios to include these metals, investors can protect their wealth from the risks associated with fiat currencies and economic instability. In conclusion, Andy Schectman's insights provide a clear and compelling argument for the strategic importance of gold and silver in the current economic environment. The ongoing accumulation of these metals by central banks and large investors reflects a growing recognition of their value as safe haven assets. As market manipulations unwind and the true supply-demand dynamics come to the fore, gold and silver are poised to significantly appreciate. For individual investors, This means the time to act is now. Diversifying into physical gold and silver can provide protection against the erosion of fiat currencies and offer a hedge against economic instability. By understanding the broader trends and positioning oneself accordingly, investors can ensure their financial security in an increasingly uncertain world. So, as Andy Schectman often emphasizes, don't just listen to what is being said, look at what is being done. The actions of the world's most influential investors and central banks speak volumes about the future of gold and silver. By paying attention to these signals and making informed investment decisions, you can protect your wealth and ensure long-term financial stability. For American and allied citizens, the strategic accumulation of gold and silver is more than just a financial move. It's a safeguard for national and personal sovereignty. As global confidence in fiat currencies wanes, holding tangible assets becomes crucial. In times of geopolitical tension and economic uncertainty, these metals provide a buffer against inflation and financial instability. By diversifying your investments to include gold and silver, you not only protect your personal wealth but also contribute to a more resilient economic foundation for your country. Remember, in the game of global finance, being prepared and proactive can make all the difference. If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.